Common Stocks and Uncommon Profits by Philip A. Fisher is a timeless classic that has profoundly influenced the world of investing. First published in 1958, this book offers deep insights into the mindset and strategies required to identify high-quality growth stocks and hold them for long-term success. Fisher's unique approach goes beyond numbers and financial statements. He emphasizes understanding a company's management, competitive advantage, and long-term potential, an approach that complements and contrasts with value investing. This summary distills Fisher's core principles, including his famous 15 points to look for in a common stock, and explains why his philosophy remains highly relevant in today's fast-paced and complex investment landscape. Whether you're a seasoned investor or just beginning your journey, the ideas in this book offer a foundational perspective on building wealth through thoughtful, patient, and well-informed investing. Welcome to Ease of Education, where knowledge meets clarity and growth begins. We believe true financial freedom starts with the right education. That's why our mission is simple: to bring you deep, meaningful book summaries on the share market that don't just inform, they transform. Our videos may be slightly longer, but that's because we value depth over shortcuts. We focus on giving you the full picture, not just surface-level ideas. No fancy graphics, no unnecessary distractions, just pure, practical wisdom that speaks directly to your goals. Every video is crafted with care to help you build confidence, sharpen your thinking, and take smarter steps toward financial success. Here, it's not just about learning, it's about growing together. Subscribe and let's turn your curiosity into confidence, one book at a time. Here's Philip Fisher's famous 15-point checklist from Common Stocks and Uncommon Profits, broken down simply and clearly for you. Let's go deeper into each of Fisher's 15 points one by one. 1. Market potential for big sales growth. Look for companies whose products or services are in growing industries or have the power to create new demand. Don't buy companies trapped in slow or shrinking markets. Find those with room to expand massively over time. 2. Management's dedication to ongoing innovation. Past success is not enough. Fisher believed great companies are those where leadership is obsessed with creating new products, finding new uses for existing products, or improving their services. This keeps growth going even when the original market starts maturing. 3. Effectiveness of R&D efforts. It's not about throwing huge money into R&D. The question is, does their R&D produce real, profitable innovations? A small company with highly effective R&D can sometimes outperform giants. 4. Strength of sales organization. Having an excellent product isn't enough if no one knows about it or can't access it. Companies with superior marketing, distribution, and customer relationships tend to outperform. Sales capability is often what turns inventions into profits. 5. Worthwhile profit margins. Profit margins are like armor. High margins give a company the ability to withstand competition, economic downturns, or rising costs. Low-margin businesses are fragile and usually have weaker competitive positions. 6. Efforts to maintain or improve margins. Is the company just coasting on past success? Or is it actively improving efficiency, cutting unnecessary costs, and raising productivity to protect and grow its margins? Fisher loved companies that showed discipline and forward-thinking here. 7. Labor and personnel relations. A company with good relationships with its employees is more stable. Bad labor relations can lead to strikes, turnover, and falling productivity, all of which are dangerous to long-term investors. Fisher saw this as a key, often overlooked, indicator. 8. Executive teamwork. It's not just about having a star CEO. Fisher valued companies where top leadership worked well together, sharing ideas, avoiding politics, and focusing on the company's growth. Toxic leadership dynamics can wreck a company from the inside. 9. Depth of management. If one top executive leaves, does the company collapse? Great companies have a strong bench, a deep pool of capable managers ready to step up. Fisher warned against companies that are too dependent on just one or two key people. 10. Good cost controls and accounting. Companies that track their costs and financials carefully tend to avoid nasty surprises. Solid accounting gives management the right data to make smart decisions and helps investors trust the reported profits. 11. Unique competitive advantages, moat. Fisher wanted companies with a moat, something that keeps competitors at bay. This could be patents, superior technology, loyal customers, network effects, or simply scale advantages. A durable edge is key for long-term success. 12. Long-term profit outlook. Is management just trying to hit next quarter's numbers? Or are they making decisions with 5 to 10 years in mind? Fisher warned against companies overly focused on short-term gains at the expense of sustainable growth. 13. Future financing and share dilution risk. Watch out for companies that will need to issue a ton of new shares, raising money but diluting existing shareholders. Ideal companies generate enough cash to fund their growth without constantly diluting you, the owner. 14. Transparency with shareholders. Fisher insisted on investing only in companies whose management communicates openly and honestly. They should be as candid about failures as they are about successes. Trustworthy communication is a core sign of strong governance. 15. Integrity of management. Perhaps Fisher's most important point. A company can have great products, high growth, and even solid profits, but if management is unethical, manipulative, or self-dealing, it will destroy shareholder value over time. Always prioritize integrity. In Fisher's philosophy, buy into a business, not just a stock. And make sure that business is built to grow, led by people you can trust, and protected by durable strengths. Now, how to use these points in practical basis. Let's bring Fisher's wisdom to life. Let's take Apple as our example and run through all 15 points using real-world logic. Here we are taking this as an example. This is neither any stock buying selling advice, nor sponsored by Apple Company. Apple versus Fisher's 15-point checklist. Big market potential. Yes. Apple operates in massive markets: smartphones, laptops, tablets, wearables, and now services. They're expanding into new areas like AR/VR and potentially cars. Huge room for future sales growth. Management committed to ongoing innovation. Yes. Apple consistently evolves its product lines, iPhone, Apple Watch, Vision Pro, and invests heavily in R&D for future technologies. Effective R&D. Yes. Apple's R&D spending, $30 billion in 2023, leads to real products that dominate markets. Think of AirPods, M1/M2 chips, Vision Pro. Superior sales organization. Yes. Apple has a global retail presence, slick marketing, and deep relationships with carriers and enterprise clients. Their brand and ecosystem lock users in. Good profit margins. Yes. Apple's gross margin hovers around 43%, very high for hardware companies. Services, like iCloud, App Store, have even fatter margins. Efforts to maintain/improve margins. Yes. Apple designs its own chips, cutting costs, boosting performance, and pushes high-margin services aggressively. They also manage supply chain efficiency. Good labor relations. Mixed. Apple itself has strong relations, but some tensions exist among retail staff pushing for unionization. Supply chain labor, like Foxconn in China, has faced scrutiny. Good executive relations. Yes. Apple's leadership is known for operational excellence and teamwork, from Tim Cook, CEO, to Jeff Williams, COO. No known internal drama. Depth in management. Yes. Apple has deep bench strength. Even if Tim Cook steps down, several strong leaders, like John Turnus, Craig Federighi, could step up. Good cost controls and accounting. Yes. Apple is famous for tight cost controls and supply chain mastery, allowing them to maintain profits even when the economy slows. Competitive advantages? Absolutely. Brand loyalty, exclusive ecosystem, iOS plus App Store, custom chips, and premium hardware/software integration create a powerful moat. Long-term outlook? Yes. Apple invests for the long term. Think about their decade-long push into health tech, AR/VR, and potentially cars. Dilution risk? No risk here. In fact, Apple aggressively buys back shares, reducing share count and rewarding shareholders. Candid communication? Mostly yes. Apple is transparent about product successes and cautious about future promises. They avoid overhyping but face criticism for secrecy around early-stage failures. Stalking the 10-bagger. The hunt for a 10-bagger, a stock that returns 10 times your investment, starts close to home. Your everyday life, your workplace, and your local stores are often the best sources of insight. The edge belongs to those who pay attention to what they already know. You don't need to be a tech wizard to win big in tech. Often, it's the users, like companies reducing costs with better equipment, who benefit most and become smart investments. Look for businesses quietly boosting profits through efficiency, not hype. Seek out stocks where the value of the assets per share is greater than the market price. That's your double edge, a hidden advantage the market hasn't caught on to yet. Your greatest investing weapon. Familiarity. When you invest in what you understand, you're already ahead of Wall Street. Understanding the stock spectrum, from cyclicals to turnarounds. In a booming economy, cyclicals shine, rising faster than the dependable stalwarts. But beware, they're the most misunderstood stocks out there. Timing is everything, and getting it wrong can be costly, especially when they seem safe. Turnarounds are the underdogs, struggling companies on the brink, or already in the gutter. But when they bounce back, they do it fast and often independently of the broader market. Spotting a successful turnaround can be your ticket to outsized gains. Asset plays are hidden gems, companies sitting on overlooked value. This is where your local knowledge and unique insight give you a serious edge. These opportunities are everywhere, but only visible to those who know where to look. Finally, remember, companies evolve. Fast growers can become slow movers, high flyers can crash. There's no one-size-fits-all rule for buying or selling. Investing success lies in understanding what kind of company you own, and adapting your strategy as it changes. The perfect stock. The best investments often hide in plain sight, behind boring names, dull products, and industries everyone else overlooks. Simplicity is power. That's why understanding the basic business is key. It's far easier to grasp pantyhose or motel chains than satellites or fiber optics. In fact, the perfect company is often so simple and unsexy that any idiot could run it. Boring isn't bad, it's beautiful. A company with a dull name, doing something dull or even disgusting, can be a goldmine. Funeral homes, toxic waste disposal, or plastic utensils may not excite Wall Street, but their predictability, lack of competition, and stable demand make them ideal long-term plays. These are industries no one's rushing to disrupt, no armies of MIT grads trying to undercut prices. Even better are spin-offs, misunderstood, ignored by analysts, and often priced at a discount. Add in little or no institutional ownership, and you've found a diamond in the rough. A niche helps, too. Whether it's a rock quarry no one can compete with or a trusted brand people return to again and again, exclusivity protects margins and ensures pricing power. Invest in companies whose products people have to keep buying: drugs, razors, cigarettes, or soda. Not tech firms locked in price wars, but businesses like ADP that use technology to boost efficiency and profitability. Finally, when the insiders are buying and the company is buying back its own shares, it's the strongest signal there is. The people who know it best believe the stock is undervalued and are putting their money where their conviction is. In short, the ideal stock is simple: boring, overlooked, indispensable, and quietly unstoppable. Disadvantage of hype. The biggest danger in investing isn't missing out on the next big thing, it's chasing it. If there's one stock to avoid, it's the one everyone's talking about, the hottest name in the hottest industry with the most buzz and the loudest hype. These stocks attract crowds, and crowds attract competition. In high-growth industries, you're not just betting on a business, you're entering a battlefield of brilliant entrepreneurs and relentless copycats. In business, imitation isn't flattery, it's a full-on assault on margins. That's why the smartest moves are often the most contrarian. Forget the next IBM, the next Disney, or any whisper stock that promises the moon on a string. These stories are all sizzle, no steak. They may dazzle with emotional narratives or clever names, but there's usually nothing of substance underneath. IPOs are even riskier, unproven, unstable, and often overhyped. Ironically, it's the boring, unglamorous companies that deliver the most consistent results. Negative growth industries, where no one is rushing to compete, often produce the best investments. They're slow, quiet, and forgotten, but that's exactly what keeps them stable and profitable. In a world chasing flash, real value hides in the shadows. By applying Fisher's wisdom, investors can move beyond speculation and build real, enduring wealth. If you found value in this summary, imagine how much more you'll gain by diving deeper, and by expanding your knowledge with other classics that have shaped great investors. Subscribe now to receive more powerful book summaries and hand-picked recommendations straight to your inbox. Looking to continue your journey? Here are some must-reads. The Intelligent Investor by Benjamin Graham, The Foundation of Value Investing. One Up on Wall Street by Peter Lynch, Practical Strategies from a Legendary Fund Manager. A Random Walk Down Wall Street by Burton Malkiel, A Modern Guide to Market Efficiency. Reminiscences of a Stock Operator by Edwin Lefebvre, Timeless Lessons Wrapped in Gripping Stories. Common Sense on Mutual Funds by John C. Bogle, for those who want to master low-cost, broad market investing.